You hand over $5 for a coffee, and it looks like the simplest trade in the world. But that $5 is about to be split between the barista who smiled at you, the farmer who grew the beans, the landlord who owns the corner, and the bank that financed the espresso machine. Whatever survives that journey is a few cents of profit, and somebody has to track where every single cent went. That somebody is about to be you. Stay to the end, and I'll hand you the whole of Chapter 1 on a single card you can screenshot. Start baby simple. Every business on Earth is the same machine. You feed it inputs, beans, labor, a rented corner, and it turns them into something people will pay for. Why build it? Profit. And profit has a formula. Revenues minus expenses. Money in minus money out. And whatever is left is yours. Machines come in 3 flavors. Service sells help. Merchandising sells products bought from someone else. Manufacturing makes its own from raw materials. Yours is a coffee shop called Maple Bean, and it opens today. Now the star of the course. Accounting is an information system. In plain English, it's the diary of your business, written in money, so anyone can read the story later. It does 3 jobs in this order. It identifies the events that touch money. It records every single one. Then it communicates the story and reports. Identify, record, communicate. Students always ask me if that is just bookkeeping. Only the middle job is. A bookkeeper writes the diary. An accountant writes it, reads it, and tells you what it means. Imagine a league where every team brought its own rule book. Nothing could be compared. So accounting has one rule book, called GAAP. In the United States, the FASB writes it, and the SEC polices it. Most of the world follows IFRS. 4 rules matter today. Economic entity. Your shop is its own person, so its wallet is never your wallet. Monetary unit. You record only what money can measure, which is why a loyal customer's smile is priceless and unrecordable. Historical cost. An asset goes on the books at what you paid, because a receipt is evidence and an opinion is not. And fair value, used when a market price is 1 click away. Before you unlock the door, one decision. Own it alone, and it's a sole proprietorship, the cheapest to start, and about 70% of American businesses. Bring in a partner, and it's a partnership. Turn it into its own legal person that can outlive you and sell shares, and it's a corporation. Or take the crowd favorite, the LLC, limited liability like a corporation, tax straight through like a partnership. The full lecture adds the specialist forms. Maple Bean opens with one owner, you. You open with $10,000 of your own money. The instant you do, a law switches on, and it never breaks. What the business owns equals what it owes, plus your stake. Assets equal liabilities plus equity. Before I draw it, predict. 10,000 in, nothing owed. What is your slice? Picture a balance scale. On the left, 10,000 of cash. On the right, 10,000 of your ownership. It's level. Now the part that matters, and here's how I think about it. It's not level by luck. It's level by construction. Every entry you make touches 2 sides at once, so the scale cannot tip. 10,000 equals 0 plus 10,000. And if the shop ever closes, the people you owe are paid first. Whatever is left is yours. That's why your slice is called the residual. So what are those 3 words really? Assets are what the shop owns. Cash, the espresso machine, the beans on the shelf. Money customers still owe you. Some you can touch, some you cannot. And a trademark is still an asset. Liabilities are what the shop owes. The unpaid supplier bill, wages, a bank loan, sales tax collected for the government. Everyone is a promise that somebody gets paid before you do. Your bank calls that Tuesday. And equity is your slice. What you put in, plus every dollar of profit you leave inside. Equity is not frozen. 4 forces move it, and only 4. 2 push it up, 2 pull it down. You invest 10,000 of capital in, so equity is up 10,000. You take money out for yourself. 200 of drawings, so equity is down 200. And drawings are not an expense. Nothing was consumed running the shop. You moved your own money home. Revenue. Maple Bean sells 4,000 of coffee this month, so equity is up 4,000. Expenses. Rent 500, wages 900, supplies 600. 2,000 consumed to earn that revenue, so equity is down 2,000. Now read the whole line. Assets equal liabilities plus capital minus drawings plus revenues minus expenses. 10,000 minus 200 plus 4,000 minus 2,000. Equity is $11,800. Miss the drawings line and you're wrong by exactly $200, and nothing on the page will tell you. Catch it every time. Future CEO. That detail separates an A from a C. Not everything that happens gets recorded. A transaction does. Most are external, between you and the outside world. Some are internal, inside your own walls, like supplies being used up. The test is one question. Does it change assets, liabilities, or equity? If yes, record it. Now the method. Read it. Name the accounts. Mark each one up or down. Drop them into the equation. Maplebean sells $4,000 of coffee for cash. Cash up $4,000, so assets are up. Revenue up $4,000, and revenue lives inside equity, so equity is up $4,000. Both sides rose together. Now you pay rent of $500. Cash down $500. Rent expense up, and an expense shrinks equity. Both sides fell together. Still with me? Good. Last one. And this is the one people get wrong. You buy the espresso machine for $2,000 on credit. Equipment up $2,000, so assets rise. No cash left the drawer. A promise was born instead. Accounts payable up $2,000, so liabilities rise. Still balanced. Every transaction touches at least 2 accounts. Never one. That's double entry, and it's Chapter 2. Your turn. Pause the video. Question 1. Maplebean owns $13,800 of assets and owes $2,000. What is your equity? Question 2. You take $200 out for yourself. Is that an expense? Pause now. Answer 1. $11,800. Answer 2. No. It's drawings, a direct cut to equity, and it never touches the income statement. Get both, future CFO, and you're ahead. Do that all year and the shop can finally speak through 4 reports. When I taught this live, the first question was always the same. Why this order? Because each report hands a number to the next. The income statement. Did we make money over a period of time? Revenue $4,000, expenses $2,000, net income $2,000. The owner's equity statement takes that $2,000, adds your $10,000 of capital, subtracts $200 of drawings, and lands on $11,800. The balance sheet is not a period. It is a single moment, and its equity line is exactly that $11,800. Then the statement of cash flows. Operating, investing, financing. Profit is an opinion. Cash is a fact. Screenshot this. The whole of Chapter 1 on one card. The 3 jobs. The rulebook. The equation expanded. The 4 statements in order. On an exam, this chapter comes at you 2 ways. Define and classify or move a transaction through the equation and prove it balances. And here's the sentence I promised you. Assets equal liabilities plus equity. Every chapter after this is a new way of keeping that line true. Before you go, one last purchase, and I'm not going to solve this one for you. You buy a $450 grinder on credit, so name the 2 accounts that move and the direction each one takes. The worked answer is waiting on the site with the notes, the practice exercises, and the full mock exams. All free. The weekly newsletter is free as well, and it brings 1 market recap and 1 options flow breakdown every single week. You did real accounting today, future CPA. Chapter 2 is where that sentence turns into debits and credits, so subscribe and I'll see you there.